Alright, hello everybody and welcome to this video. My name is Victor from the GMBox trading team, and today we are going to talk about algorithmic trading systems in the stock market. So, the contents are the following. First of all, I'm going to do a brief introduction about this video. Then we are going to talk how the stock market works, some of its features or characteristics. Then we are going to create a trading system, and finally I'm going to give you some of my notes and a brief summary about what can we do with this information. So, in the introduction, we call equities to all listed instruments related to corporate capital. That means to participations of a certain company, or as it is called, stocks. Alright, so we will usually talk about the stock market and stock indices. When we are talking about stock indices, we are talking about an aggregation of a certain number of stocks based on a fixed criteria. That means there are certain criteria that stock indices follow to determine its composition. For example, where the stocks are listed, if some stocks are listed in Spain, that means that we can create an stock index based on Spanish companies, economic sectors such as technology and biotechnology, pharmaceuticals, the automotive industry, etc. Market capitalization, that means the price of a stock multiplied by the issued shares, and weight assignations. In this case, weight assignations in most stock indices, the criteria is this. The bigger is the company in terms of market capitalization, the bigger will be its weight on the index. This works for most of stock market indices, except for the CAC 40, the French index, that all companies tend to have the same weight in the index. So, indices part 2. An index is a non-tradable calculation, okay? There is a big misconception about the futures market or the ETF market or the futures market are the index as it is the calculation. That's wrong. An index is just a formula with these criteria that we have seen in the last slide. So we can use derivatives to trade an index, but never the original calculation. Some popular indices are the Standard & Poor's 500, the Nasdaq, Dow Jones, DAX 30 from Germany, IBEX 35 from Spain. In this video, I'm going to be talking mostly about the Standard & Poor's 500. And what are the advantages on trading indices? First of all, we avoid idiosyncratic risks. That means risks that are highly correlated to a sector. At least in most cases, if I'm trading a technology index, I'm not avoiding any idiosyncratic risk, but if I am trading a certain country index, I'm avoiding it. That means if the technology sector is in a bearish period, there is a crisis within the technology companies, and I also have exposure to pharmaceutical companies, I will be mitigating that risk. Anyway, we also avoid financial frauds like the recent one made by Wirecard and the survivorship bias. This last concept is very interesting, and it's easy to explain it if we avoid for one moment the financial aspect of the definition. We are going to go back to a time where the Brody helmets were introduced into the US Army. The Brody helmets are the usual helmets that you can see in movies related to war, like Full Metal Jacket. You know what kind of helmets I'm talking about, those metal ones without round shape. Alright, so when those helmets were introduced into the army, the chain of command noticed a pattern. Now more people than ever go to a hospital because they are injured, and the first thought, and if you think about this, the first one you hear it, this is very reasonable. If they are using helmets and they are get more injured, then why are we using those helmets? People is getting injured, and as a first thought, this is a concept that can make sense. But if you think twice, you are going to notice a pattern here. More people are getting injured because less people are dying thanks to the helmet, because now they don't have wounds in their head. And what does this have to do with the stock market, you may ask? If a company is going bankrupt, like we record, in the moment that this company doesn't comply with any of the criteria required by a certain index, this company is getting out. So instead of exiting a position on wildcard and the current price, we probably will exit the position at a price of $80. Why? Because market capitalization is going way down and the liquidity is going way down. So in this case, if a company goes bankrupt, we don't experience that, and also when we are doing our analysis, we don't need to have all the historical data of bankrupt companies. Besides, the stock indices have lower correlation with other types of assets like forex or commodities, and it is relatively simple to build long-term trend following trading systems. So how can we trade this type of assets? First of all, we need to study the market. We need to develop our routine about what questions do I have about the market and how can I solve them, usually doing a backtest. So what are the main features of this market, what time frames should I choose, and what instruments I can trade? Alright, so the first feature is the trend. Stock markets tend to have a bullish bias over time due to macroeconomic factors, mainly inflation and interest rates. In the following chart about the Dow Jones Industrial Average, we can see more than 100 years of data. And despite having various moments, financial crisis, and some pullbacks or rebounds, we can see that over time the stock market will tend to go up, since inflation is making our money worthless. We have a certain type of interest rates that in the stock market are translated as risk-free rates. That means if interest rates are at 2%, the stock market risk-free rate as a measure will be the same 2%. And the second feature, my favorite, is volatility. At some point, volatility will increase, and that's the first sign of a financial crisis or a bearish market. Why? Because when volatility tends to go up, that means that there is a sell-off in the market, there is some panic, and this not only happens to stock indices, this is also that happens to the yen, to Swiss franc, in some cases to gold, due to a sell-off by hedge funds and more assets. But first thing, high volatility, that's a bad thing to us. In fact, if you want to check this with some accurate data, go to Google and search for ETFs that are based on low volatility, replicating the 100 least volatile stocks on the Standard & Poor's 500, and then you can go and compare it to this index, and you are going to see that low volatility tends to outperform in the long term to our regular index. That's called a smart beta concept. So now we know the features, but we don't know what time frame should I choose. And this is a very interesting question, because if I'm going to use an intraday time frame, we are going to indeed need high volatility, because otherwise spread and commissions are going to make our trading systems unreliable, because the expectancy of those systems will be very low. But if we are going to trade in the mid or the long term, we need to know another concept. This concept is called risk premia. We are being compensated if we assume overnight risks. This works like an insurance premium. When I invest in the stock market, I'm receiving a daily premium, just for the fact that I am there, assuming the tails of the distribution. So it usually will go up, I don't know, 1%, 0.5%. But in the case that we are going to see the stock market tails, just like here, I'm going to experience a very high volatility, and I'm going to assume a lot of risks. But as you can see, this is another reason that the market usually goes up, because I'm collecting my premium. So, what instruments can I trade to create a trading system? I have three kinds of instruments. The first is a CFD, a contract for differences. In this case, this is the all-weather instrument, because we can use it for everything. I can use a Standard & Poor's 500 CFD to do an intraday trade, but also to open a position and hold it for 6 months. But if I want to have a long-term focus, the best thing to do will be to use an ETF, because first of all, commissions on the long term are very low. Instead of paying a swap like in a CFD, usually I won't pay in anything, or just a maintenance fee of my overall trading account. But in this case, we can use any leverage, or best case scenario, we can use 1 to 10 in intraday and 1 to 2 overnight, and that is nothing. And we can use futures and micro futures for our short-term trading focused on high leverage. That means that we are going to use a high leverage and have very small point objectives and time frames when we are trading this. Usually tick charts or minute charts, but in this case, for the trading systems that we are going to study today, CFDs or ETFs are the best option to do or to use. So let's create a trading system. I have two ideas based on the previous comments and statements that I have made within this presentation. First of all, I'm going to have a bullish bias, because I only want to go long in the market since it's the main trend, and I want to have a very low volatility, because low volatility equals to stable returns and equals to a low perceived risks on the market. So first question, and this is a good one, I want to buy a new high or a new low. Alright, this is the first question I make, and common sense tells us to buy a new high. But let's see what happens after a new all-time high. 1 day duration, that means yesterday was the all-time high, I buy today and I will sell tomorrow at the opening. So 43% of the trades are profitable, and it's certain that the average profit trade is greater than the average losing trade, but as we can see, we don't have a decent ratio over here. By the way, this is the Standard & Poor's 500 using historical data from 1994 up to today. Alright, we can see an interesting pattern over here, that is in 2014, 2015 and up to 2017, we can see that this pattern started to change. This is to retail trading. This is a period when the markets at a retail level were very popular due to the new era of CFD trading, spread betting, even binary options. So that at this moment the market was very bullish. Everyone thought they can win money just throwing a coin. If it's heads, I will buy. And as you can see, if it is tails, I will short sell. In this case, as you can see, this is a completely random pattern, and we can use that. But what if we try to trade new lows? We want to buy the dip. Buy the dip, a classical market slang. This means I'm going to buy the pullback. This is very popular nowadays thanks to Bitcoin traders, but this was equally popular 20 years ago thanks to Squawkbox, Maria Bartiromo, and programs and personalities like that. So how do we quantify this pattern? Okay, I want to try to buy a new low, but this is harder than say I want to buy a new all-time high, because all-time lows are not frequent in the market, because a time series that started 100 years ago, that means that if currently I have a new low, I see a new low in the stock market, that means that this is the end of capitalism. So let's all turn down our computers and forget about the market. Okay, so my first idea is buying when the price falls below a certain threshold in terms of supports. That means in this case a new 5-day period low. And as we can see, we have here a better chart, a better backtest. As we can see, we have a profit factor of 150. Our ratio of profitable traders are about 58%, and average profitable trade is greater than the losing trades. So we have here a pattern to start trading. So what we are going to do, knowing that the pattern is to buy the dip instead of buying a new high, we are going to improve the results with the indicator RSI, the Relative Strength Index. This is an oscillator indicator based on the average winning periods and losing periods, and it shows a normalized data. This oscillates between 0 to 100. Usually the 14 period RSI is the standard, but that's focused on a long-term trend that we already know what the trend is. So we are going to use a shorter period. We are going to create a system with the 2-period RSI. So the rules for our trading system will be the following. Notice here that the RSI2 is the draw pattern, and these two are the filters. Alright, so this is the main concept. If RSI is below 17, the average true range indicator of 35 periods is below the average true range indicator of 70, and if the momentum indicator of 11 periods is below the momentum indicator of 22 periods. Why? Okay, the RSI, because at a short term it shows us a pullback. The ATR is this indicator right here, measures volatility, but since this is measured by points, I want to have a relative comparison to see how the market terms of volatility are compared to the usual. Same applies to momentum. In this case, I'm using momentum to measure the current returns against a bigger time frame return. So once a pullback, but in low volatility, and returns should be slightly lower in the short time frame than in the bigger period. So this is the system results from 1994 up to 2020. Okay, here is the backtest. I'm running an analyzer on this, and as we can see, we have a curve ratio very decent, a profit factor of 2, a drawdown of only 200 points, that is measured as regular points, even if this is a CFD. And from 1994 up to 2020, we have earned more than 100 sorry, 1,800 points in the markets. And we are talking that when I started this backtest, the Standard & Poor's 500 were at 400 points. Now is today is higher than 3,500 if I recall it correctly. So you can see that there is a huge number of pips here. Alright, so some measurements, 152 total trades, 65% are winning trades, time on the market is about 20%. The average time is 13 days, in this case 9 market days, but this offer also counts Saturdays and Sundays. And as you can see, this is a very interesting trading system. This is the Montecarlo simulation. And the main concept of this system is that in assets that have a predefined trend, it's a good idea to search for pullbacks. Buying a new all-time high can seem like a great idea, but we are falling in the negative bias. Okay, we see that markets tend to go up, but in this case, the pattern is in our brain, but this isn't in markets. The short term, this isn't the brightest idea. So now what we do is try these mentioned things in other assets. For example, there is a correlation between the Japanese yen and the stock indices, and we can also trade this on Bitcoin. We can test it. We can test this in another stock markets, in the Aussie stock market, French stock market, the Euro Stocks 50. The main idea of this trading system is just to detect a trend and try to buy each dip. But in trading, along with other things in life, you have to be curious. That means giving you the main idea on some filters. Try another filters, try another rule, try another assets, try another time frames instead of a daily. Try the time frame, try the H4, H1, or even try to make a filter on intraday and try to do this on a 10-minute chart. Alright, so this is all for today. I hope you like this video. If you have liked this video, please press the like button, subscribe to the channel, and leave a clean comment showing some support. And I will see you in the next video. Bye.